But for the timing, let's move on. And it's IPO Street, which is buzzing and as alive as ever. Today, it's all going to be about a large issue that's coming to the market. Tata Capital's 15,000 crore rupee IPO is opening out. It is the largest issue of the calendar year so far. And we have the main gentleman with us, Rajiv Sabharwal, Managing Director and Chief Executive Officer of the company, joining in. Mr. Sabharwal, thanks so much for joining in. And, it's a pretty momentous time. Every time a Tata Group company comes to the public markets, obviously there's a lot of excitement. Now, people really want to understand the business and what your vision is going forward. Because if I look at the FY25 performance, then the overall growth was, absolutely, it was a blitzkrieg over there. I think 40% growth, right, on the book. However, there are those who also point out that your yield on advances and margins have been lower than your, peer set NBFCs. So, is this going to continue, that you will focus on that kind of growth, even if margins, say, remain slightly lower than the average? Or is there going to be a change once you become a publicly listed entity?
So, if you look at our overall growth, we had the impact of the merger of Tata Motor Finance last year in FY25. Though we got the merger approval in May of this year, the merger dates back to 1st April 2024. So if you exclude Tata Motor Finance book, we've been growing at 25% plus over the last few years. We believe India provides that opportunity of growing at that space. And it also happens because we are present in all segments. Retail and SME, which form about 88% of our book, itself grows at about 17 to 18% in the Indian credit market. And besides this, we are also present in the corporate space. So being present helps us. In terms of margins, I think our margins should be looked at with perspective to our credit costs. Our credit costs have been the least in the industry. If I take away the merger of Tata Motor Finance, Tata Capital has always had credit costs of below 1%. As far as the future is concerned, I think we've always looked at how we can add new products and grow them, which provide better margins. If you look at our housing business, affordable housing is the fastest growing segment there. It is growing at over 30% over the last few years. And we are among the top 2 or 3 companies in that space. We always look at that.
On affordable housing, Rajiv, good morning. Most NBFCs we speak to, they kind of lament the fact that affordable housing is a segment. When there's not enough stock on the affordable category to fund. That's the feedback that we have gotten occasionally. Is this on Tata? I mean, is there a lot of group? I mean, are you lending to, say, Tata Housing and developments, etc. there?
No, that is a very small portion. Okay. That's not the big thing. But, when we talk about, affordable housing and the stock being limited, we are actually talking about the organized developers. But if you purely look at affordable housing, it's largely a self-construction market. 80% of what we fund there is actually self-construction. When we go deeper into the markets, that's where we realize the real India is throbbing and alive, and there is a lot of activity.
So how does the loan book break up? I mean, so retail is about 60%, right? And that includes housing is within that. So just give us the broad areas where...
So, Brian, if you look at our book, about 63% is retail. Roughly half of that would be housing, and half of that would be other consumer loans. About 25 to 26% is SME, and the balance 11 to 12% is corporate.
Just to go back to the point on margins and yields, I guess it's also a function of, because all put together, I think over 70% of your book is secured, right? I mean,
actually speaking, if I talk about retail unsecured, which was in the
big talking point
last year, that is just short of 12% in our total book. So largely, our book is secured in nature.
And do you intend to keep it that way? Because for a lender, that's always going to be that question to ask, the trade-off between higher yielding unsecured assets versus secured, slightly lower yielding assets. So do you intend to keep it at 12%?
So our approach is to create a very resilient book, an asset book which should not only do well when times are good, but should do well also when times are not so good. In terms of our mix of retail unsecured, what we have seen in the past few months, that the worst of credit cost is behind us. We will watch it over the next few quarters. And if things go well, we will look at accelerating that growth too.
Consumer segment,
the unsecured part of it.
Rajiv, consumer segment is 30% of the loan book, right? Consumer finance. And SME is another 26 odd percent. the GST cuts that happened, it's supposed to show up in a big way. I mean, I've spoken to companies like Bajaj Finance, etc. as well. Yeah. These are the two areas where it's supposed to have an outsized impact. Are you already starting to see some of it?
Absolutely. This is actually, if you look at it, it's a very significant cut. It's not a small tinkering, it's a big cut. And the impact is visible whether you talk about PVs, CVs is still taking some time, but if you talk about two-wheelers, tractors, I think this is clearly visible. I think there are some products where the impact is immediate. There'll be some products where through the raw material, the impact will be seen over the next 3 months or so. So I think we are really expecting Q3 and Q4 to be really bumper quarters for this year.
All right. Hi, Mr. Sabharwal, and thanks a lot for coming down to the studio. A couple of quick questions then. Part of the issue will be a fresh issue. So how does it change your return ratios? If you could give us a sense on that. And also, if I look at some of your peers, whether the commentary that's coming in from Bajaj Finance or even in HDB or even Chola, which is, one of those companies that has been the leader in the last few years. They said, one of the comments that they made was, this year is a year of collections, not of disbursements. That's giving you some sense of the industry. What is your right to win? Because some of those shareholders in the unlisted market bought the stock at a much higher price. So there will constantly be that concern on that front. So return ratios and your right to win.
So if you look at our offering, it's a mix of primary and offer for sale.
Yes.
With the primary offering, our cap ad, which is will go up to over 22%. Our leverage will come down to below 5%. As far as returns are concerned, I think you need to give the organization another 1.5 to 2 years to fully utilize this money so that the return ratios keep getting better. I feel when you talk about the credit quality and such issues, we've been pretty quick on responding whenever there were challenges. In fact, when we saw challenges in certain segments, we became tighter and more conservative. And that was reflected in terms of our growth in those areas also. As I mentioned just some time back, we feel the worst of credit cost is behind us.
Okay.
And we should start seeing only better things. The reason also is because the market also has become far more responsible, both on the retail unsecured side. The other side which faced a problem was microfinance, and MFIN brought in a lot of regulations. So those things, I believe, have made the market more stable.
Okay. So, talking about capital support, like Prashant mentioned, because less than half of the issue is a fresh issue, the rest is in OFS. How well capitalized will you be? Will there be the need to look at any further equity capital support from the parent? Just a bit on the capital structure going forward after the IPO.
We've always had tremendous support
from your parent,
absolutely. Both our Tata Sons chairman, Mr. Chandrasekharan, and Saurabh have been extremely supportive. As far as this money which we are raising at this point of time is concerned, this should allow us to grow along with our own profits for the next 2.5 to 3 years. And post that, we may be in the market again to raise money.
Okay. 2.5, 3 years. Okay. And any sense of, you're saying that, so obviously you see a lot of growth in the future. But what would be the capital requirement if the growth expectations are met? And you say you've been growing at about 25% anyway, ex of the Tata Motors Finance business.
If you look at it, the market right now, we are raising about 6,846 crores.
Correct.
Plus there will be internal accruals through profits coming in. I think a combination of this, we do believe, will be sufficient for us to give us a growth rate, which should last us for the next 2.5 years. We can't talk about the future growth rates, but if you look at the past few years, we've been growing at 25% plus.
Rajiv, on a lighter note, not a lighter note, it's a serious question, but maybe prefacing with a lighter comment. By the way, missed you at the Banking Financial Services Summit this year. I had you on the NBFC panel, I think it was last year, the year before that. This year we had an interesting gathering, and I was just saying that banks are like airlines, right? I mean, they carry heavy loads, regulated, strictly on schedule, etc. Fintechs are like, ride-sharing platforms, sleek, sophisticated, kind of sexy. I mean, if you go there. And NBFCs are like railways. I mean, they take a load of people and go where others don't want to go. So there'll always be NBFCs which do well through cycles, and we've had a few of them. But just in terms of the ability of what banks can do now and what NBFCs are able to do, allowed to do, you just saw, right? I mean, RBI's measures, nothing on the monetary policy side, but lots of regulations, really unshackling banks and allowing them to really do a lot more. Is that going to be an issue? Not an issue, but banks are big competitor in that sense. In many areas which so far were largely sort of served by NBFCs.
So that's always been true, Prashant. In the Indian market, competition is given. Whenever you find a segment which is profitable, there'll be 10 more companies wanting to jump into that. Luckily for us, this is a more regulated market, and things are more sane here. If you look at the whole set of banks, you will realize that there are top banks and then there are another set of banks. Even if you take the top private banks and when you look at us in size, we'll be in the top 6 or 7. Similarly, there are NBFCs which are at the top and there are other NBFCs. So if you talk about us, what we are seeing is because of the trust which we enjoy, the credit rating which we enjoy, we do get the benefit of one of the lowest cost of funds in the market. And the ability to then target the best customers is possible for us, which again leads to that whole virtuous cycle of getting a lower credit cost and then again getting a lower cost of funds. So I feel this market will remain competitive. We will all have to figure out our own niches to play in. And the good part, what we are seeing in India is it's huge. We continue to expand and we continue to see opportunities. So that's the plus point, and the growth is visible in all markets.
Which brings me back to the same point. I have to ask you this. On growth, I don't think the market has any issue. On the pedigree, absolutely no issue whatsoever. The only bugbear has been margins. But you've said that if things remain stable, you may want to build on the unsecured book as well. So your margins have been between 5.2, 5.3% largely. Is there an aspiration to start going towards 6, maybe 7, and inching towards high single digits at some point?
So if you look at NIM plus other income, we are just above 6, around 6.1%. And clearly, in terms of what returns come in, one benefit does happen from margins, as I mentioned, that we are adding more of high NIM products, which should give us better things. The other benefit which accrues to entities like us is cost to assets. Because of the significant benefit which we are seeing on account of digital and now Gen AI, we do believe that there will be a step change in cost to average assets over the next few years. Just to give you a sense, our housing company in March 23 had a cost to income of 40%. In the quarter which just went by, it was 31%. Because of the huge impact of digitization and our investment there and Gen AI, you will start seeing a big plus also coming in from cost to average assets.
Okay.
Well, Rajiv, we'll leave it there. Thank you very much. I hope this is the first of many discussions as you start your listed journey. Good luck for the IPO.
Thank you so much.
Thank you very much.